Hey there, welcome to this guide on understanding futures contract expiration day. But first, let's just cover the basics of futures trading. What is it? Contracts are agreements to buy or sell an asset at an agreed upon price, an agreed upon date in the future. It's really important to know the expiration dates, and you must know that you need to close out positions before expiration. So what are the pros and cons of trading futures? We're going to touch on this quickly. Leverage. They allow you to control a larger position with a smaller amount of capital. And it can amplify your profits if the market moves in your favor, and the opposite is also true. We have liquidity, highly liquid generally. So there's usually enough buyers and sellers for you to enter or exit your positions pretty quick. Diversification, there's a whole range of asset classes you can use. We talked about this earlier, and you can use these to diversify your portfolio and just spread your risk around to different market sectors. You can hedge, so you can manage price risk and protect against potential losses. By taking a position opposite to existing exposures, you can offset the impact of price movements that go opposite your direction. Now, there are some cons. They're volatile, can be pretty volatile, significant price swings. And volatility is not bad. It can result in high profits, but you also have the risk of big losses. Time commitment. If you want to actively trade in futures, it does require continuous monitoring and analysis of the price. Price movements can happen pretty rapidly. Complexity, well, sometimes they can be a little bit complex. The financial instruments and the market dynamics, how it moves, understanding the intricacies of futures contracts, expiration dates, how you settle it. And margin call is always a risk because it involves margin. That's just a deposit that you have to maintain to cover a potential loss. And if your account balance falls below the required margin, you get a margin call. You're going to put additional funds in there. So it is really important to understand both the positive and negative aspects of trading futures, but a lot of people do it, and a lot of people do it successfully, and a lot of people do it successfully for a living. Now let's take a closer look at the key aspects to consider when you're trading different types of contracts. There's lifespan of contracts. There's varying durations before they expire. Some expire monthly, others expire quarterly or on specific dates throughout the year. So it's really important to be aware of the expiration dates of whatever you are trading. Closing out methods. Each are going to have different rules for closing out positions. One common method is just offsetting your position. That's just where you take an opposite position in the same contract with the same expiration date. So this will offset or cancel out your original position. Allows you to close it out. You can obviously take physical delivery, cash settlements, or just roll over your contracts to longer dated ones. All depends how things are going for you. Marking to market. This is a process where you just regularly assess the value of your contract positions. You got to compare the current market price of the contract to the price at which you initially entered the position. So this is going to allow you to track your gains, track your losses, and determine if you're going to have to use additional margin. Offsetting positions, we talked about that. Just taking an opposite position in the same futures contract. So let's say you hold a long position, so you're expecting prices to go up. You can offset it by selling an equal amount of contracts to close out your position, offsetting your position. So just understand the differences in these aspects across different types of contracts. It's pretty crucial for trading. It's really important that you review that contract specifications that's provided by the exchange. That's where the future contract is traded. You got to know all this stuff. So let's talk about closing out. Let's get right to it. Several methods to understand. Number one, we talked about offsetting positions. It's a common method. Again, it's just where you take an opposite position in the same contract. So there's advantages to that. It's pretty straightforward. It's an efficient way to close out your contracts. It eliminates the need for physical delivery or settlement of the asset. Offset positions can be executed quite quickly. Provides flexibility, pretty responsive to changing market conditions, but there's also considerations. You got to ensure that the contracts being offset are of the same type, same expiration date, same quantity. You also want to account for transaction costs like fees or commissions because these are associated, of course, with trading. You can take physical delivery. Some may do that, right? For commodities like agriculture products, precious metals, energy resources. Now, the advantages to that, and now let's be honest, most of us out there, retail traders, will never, ever take physical delivery, but you should know it. It just allows you to receive the actual underlying asset. Enables you to use it for whatever purposes, like you're a farmer or something. And it can be beneficial for those who need that physical asset for their business operations. Again, farmers or lumber, anything. Now, also remember, when you take physical delivery, there's also costs such as transportation, storage, inspection fees, all depends. Just ensure that you have the necessary place to put all this stuff. But you probably will never do that. But again, just having a wide-ranging education on this is important. Cash settlement, another method to use, most commonly found in financial futures contracts. That's the cash settlement. No physical exchange of the underlying asset happens. Instead, it's just based on the difference between the contract price at expiration and the market price at that time when you picked it up. Now, rolling over contracts. This is always interesting. And this involves switching from an expiring contract to a new contract with a further out expiration date. So this is going to allow you to maintain your exposure to whatever the underlying asset is beyond the original contract's expiration date. Let's get to expiration date. Let's talk about rolling it over. You have to decide whether you're going to switch to another contract or settle. Rolling over, again, just means switching to a contract that expires at a later date. And there's quite a few people that do that. So as expiration date approaches, you may need to roll it over to avoid any costs. We can settle our contracts. If you don't close it out when you expire, well, they're going to settle according to the terms of the contract. And this usually will involve physical delivery or cash settlement. All depends on the specific futures contracts. Talk again about marking to market and managing your position. Again, it's just keeping an eye on the value of your positions all the time. This way, you're going to know if you need more money in your account or if you're making some pretty nice profits. Again, when it comes to settlement, futures contracts can be either cash settled or physically delivered. Most people opt for cash settlement. All about, at the end of the day, simple. You're going to roll over or you're going to settle. And be honest with you, most people never hold till expiration. They buy and sell when it hits their profit targets. That's just pretty much how it goes. But understanding the contracts in general, it's pretty important just so you're an educated trader. Bottom line is you got to know the different types of futures you're trading and how you can get out of the position. That's it. It's pretty simple. Thanks for watching. Make sure you hit like, hit subscribe. We'll talk to you soon.